Hello and welcome to Livewire's Fund in Focus. My name is Chris Conway. Today I'm sitting down with Sebastian Mullins from Schroders. Sebastian is going to be talking to us about the Schroder Global Equity Alpha Active ETF, trading under the ticker ALPH. Seb, nice to see you as always.
Thanks for having me, Chris.
Of course. Can you just take us through the strategy, Seb, and what sort of investor it might be suitable for?
Sure. The Schroders Global Equity Alpha Fund, or ALF on the ASX, is looking to create a highly concentrated portfolio of 40 to 60 stocks of the best ideas that the Schroders analyst and PM team have across the world. So really analyzing 4,000 stocks across the universe, picking the absolute best stocks we believe will deliver on returns by looking for what we call the growth gap. That is, what is sort of the streets or the market expectation for earnings per share over the long run. And if our expectation is higher than that, we allocate to those funds accordingly. Now, of course, it's hard to do it to pick stocks, and there's that many around there. But thankfully, at Schroders, we have 1.5 trillion under management globally. We have 160 analysts, I should say, globally over 17 countries, whose job it is to kick the tires, find those companies, and then support them up to the portfolio management team. And we also have 12 sector specialists who then decide on how that stock fits compared to their global competitors. So having that team behind us allows us to pick the best companies. Now, for us, being active, we believe in active management. So there is inefficient markets, and because of that, we do think you can outperform. People tend to extrapolate bad news into the future. They fail to overreact on bad news. They anchor on their current earnings per share, to see how that can compound over time. They also just can't see catalysts that might form the market. So we do believe you can outperform in an environment the market is inefficient, and having that quality team globally allows us to pick those best stocks. Now, in terms of who this is best suited for, is for clients who want to diversify away from their Australian equity portfolio. Australia accounts for maybe 2% of the global equity index, so allocating to the 98% makes sense. You can diversify away from your country risk into global countries, also different sectors. For example, Australia is concentrated in mining, resources, banks. Why not hold some more tech companies or some medical companies that you get offshore? So diversify away from Australia, allocate to a long-term compounding long-term return. So not suitable for short-term investors, but medium-term investors of 5 to 7 years who want to outperform the global index and get that diversification benefit away from the Australian portfolio.
Seb, let's talk portfolio construction. How does your approach shape the way that the portfolio gets put together?
Sure. Well, the core of our process first starts on what we call finding the growth gap. So we look at companies, we try to determine what our estimate is for their earnings per share over the long run and compare that to what the market or other analysts are anticipating. So we bucket that into two different sections. One is sort of your core compounders, where we allocate maybe 60 to 70% of the portfolio. Those are high quality companies, market leading names with a very, very deep embedded competitive advantage. They might have killer products that we all know and love and use, or they might have great technology, IP, or maybe even patent protection. But finding these high quality companies where their growth outperforms what the market's expecting over the long term is where we want to allocate our money to. The other side is more opportunistic investments. Same thing, trying to find that growth gap, but it's more about companies that have a short-term catalyst that might be more cyclical in nature. Maybe they might have released a new product that is game-changing. Think, for example, Apple with the iPhone, where we think the analysts in the street aren't actually anticipating how that might turn around quickly. So we see opportunities there. It's a shorter-term hold, maybe 1 to 1.5 years. That's around 20 to 30% of the portfolio. There's turnaround stories where growth we think is going to outperform what the market's anticipating. So those two combined, we find the best high-quality company where that differential is the greatest and allocate accordingly to those best-in-class stocks in a concentrated manner.
Seb, you've given us the theory. Can you talk us through what's happening a little bit in markets right now? What are one or two big themes that are driving current performance in the portfolio?
I think volatility is a big one.
Yep.
So everyone's been talking about Trump, trade wars. It was America first, now it's America last. Make America great again, now it's make Germany great again. China's uninvestable, now it's the best place to be. There are so many narrative shifts in just 3 months that it can really whip investors around. And I think that really calls to the point that if you're investing in equities, it's a long-term view and you want to find high-quality fundamental companies. So that's our job, right? Picking the best companies, the best stocks can outperform in the long term. That's provided us opportunities. So we're talking about Germany, for example. That's done extremely well performance-wise in the last couple of months compared to the US. Within Germany, we like SAP. That's a company we've recently, well, not recently, we've had it for a while, but a large overweight in the fund, recently delivered fantastic returns. outperformed the German benchmark by 14%, the S&P by 30% just over the last 12 months. Because the AI theme that pushed US equities higher was finally found in Europe and realized there's another stock we can buy with similar characteristics. They're focused on cloud computing right now, but otherwise they're sort of data provider or data logistics data provider for companies. Another thing we have, for example, is this decarbonization or energy infrastructure play. Trump's coming out with some interesting policies, but ultimately he wants to be self-secure in his trade routes, but also his energy independence and critical minerals, et cetera. Part of that is building out the energy infrastructure. We own a company, it's a GE spinoff, and their job is to actually find and improve the US energy infrastructure. So they have long-term contracts with the US government to build that out for them. So again, opportunity, volatility, but finding these companies that will benefit in this environment is our core process.
Seb, you touched on it there, provided a really nice segue, but let's talk to risk management now. So one of the advantages of being active is that you can be nimble, and you eloquently sort of talked about it there. How else are you able to manage risks within the strategy, and even particularly when a position doesn't necessarily go the way that you want it to?
For us, there's two layers of risk management. First is the fundamental risk management of the stock and company themselves. So we talked about the growth gap. That gives us the green lights for returns, but what risk is associated with that potential gap. So we look at what we call fundamental risk of the company. That can be financial, like how much operational leverage or financial leverage does it have? Is the balance sheet in good stead? Is the accounting conservative? And non-financials, like how good is the management team? ESG concerns, for example. What is the industry or country they operate in? What risk is going on there? That gives us a risk score for those companies. We want to allocate more to a high growth gap with low risk. Obviously, the higher the risk, the lower the allocation in the portfolio. That determines our sort of portfolio construction within those names. Now, if the growth gap diminishes quickly, we get out. If the risk grows above our tolerance, we get out. So very strict risk control on selling those individual companies. At the portfolio level, we mentioned we're highly concentrated. Our job is to pick the best stocks in the portfolio. We don't want that to mean we have crazy equity tilts in different countries and sectors. We want to have stock selection alpha to our clients, not massive shifts in country and sector selection. So we do that by ensuring we do take some, but minimizing the tracking error we have in those country bets and those sector bets. That means if you look at our risk contribution, it's mainly from stock selection, which is what you want. If we do find some interesting opportunities in a different country, we might get slightly overweight or underweight, but we're not taking massive bets there. And that's why if you look at our performance, because of that top-down and bottom-up risk control, we deliver very consistent returns. So our alpha in this fund over 5 years against the Global Equity All-Country World Index is 2% per annum net of fees, slightly above that. Now, past performance, no indication of future performance, of course, but it just shows you how we have delivered. And we've had a consistency hit rate of 62%, which is quite strong.
Yeah, absolutely.
And we have upside capture ratio above 100% and downside capture ratio of 90%. So participating in upside, but minimizing that volatility in the downside. So high alpha, high concentration, but minimal risk delivers consistency of returns for our clients.
There's some pretty impressive stats there. Well done. Last one, Seb. Where do you see ALF sitting in an investor's portfolio?
I think it's very important to think about concentration in your own portfolio. If you're highly allocated to Australian equities, that's done a great job. Handful of names to dominate that market. Australian equities is a highly concentrated market. If you want to allocate away from that, going global, we think makes perfect sense. First of all, you get geographical diversification, you get industry diversification with different names and different industries that you have in Australia, and you also have currency diversification. In a sell-off, normally Aussie dollar falls, and other currencies like US dollar, euro, and Japanese yen tend to rally. That can offset some of your losses, historically speaking. So diversify away, find long-term growth in these highly lucrative compounders overseas with the ability to go anywhere, find the best countries and the best stocks, but also ensuring that you have that risk control and active stock picks within that. It's easy to buy an ETF, it's harder to pick winners and losers in the volatile environment that we're currently in. So again, for an active management strategy, picking the best companies, diversifying across countries, sectors, and regions, and allowing people in Australia to have allocations to those overseas companies.
Seb, it's always a pleasure. Thanks for taking us through ALF.
Thanks, Chris. Thanks for having me.
If you enjoyed that Fund in Focus, make sure to give it a like, and don't forget to check out the rest of the listed series content available on the Livewire website. Thanks for watching.